Hello and greetings to everyone who's dialed into this webinar. So hopefully you can see me clearly and you can hear me as well on video and on audio. We're very lucky today to have an excellent webinar show where we will have a debate between somebody who's very hawkish on the Fed and someone who's more dovish, very much so more dovish on the Fed. So just for background, my name is Bilal Hafiz. I'm the CEO and head of research at Macro Hive. And Macro Hive is a leading independent research platform where we cover every single market, and we have research products for both institutional investors and for individual investors as well. Now, in terms of the characters involved in this debate, we're very lucky to have Alex Gurevich, who is the CIO and head of his hedge fund, HonTe Investments, which he's been running for a number of years now. Before that, he had a very high-profile and successful career at JP Morgan, and he has a good profile in the market, well respected by pretty much everyone I know, as well as myself as well. And he's been a guest of our podcast show as well. We also have Dominique Dwor-Frecaut. She is a researcher at Macro Hive itself. Dominique also has a very impressive background. She worked at the IMF, the New York Fed, and Bridgewater, amongst other things. Dominique also has this view that the Fed will end up raising rates to 7-8%. Alex, meanwhile, thinks that the Fed will end up cutting rates quite aggressively in the next year or so. So we're set up to have an interesting debate between the two. And the aim of this is to really educate our audience to give the nuances behind the hawkish case and the dovish case. So whichever flavor of view that you follow, you can learn something from this debate. Now, in terms of the outline for the debate, the way we'll do this is each of our participants will have 10 minutes to present their case. Alex will go first, followed by Dominique. Then each of them will get 5 minutes to provide their rebuttal to the other side, and then we'll go to Q&A. So if you do have questions, there's a Q&A button on Zoom. So just type in your question. You can ask at any time, and I'll collect them towards the end, and I'll fire them to the participants. So sit back and enjoy. Let me now start the debate with Alex. So Alex, if you could reveal yourself and unmute yourself. So welcome, Alex. It's great to have you on this debate show. So why didn't you kick off and give us your case for why you think people are too hawkish and on both inflation and the Fed for the coming few years?
Well, first of all, Bilal, thank you very much for having me, and I really look forward to this debate format, which will present viewers a balanced view. Thanks everybody for logging in to this. This should be good. So before I start arguing, I want to clarify. I'm a trader, not an economist, and not a researcher. What that means that what I'm looking for is not the solution of what inflation is going to be or what GDP numbers are going to be. I'm looking for a trade. And what does it mean to have a trade? To have a trade is to know something about the price of any asset in the future. That is, you can say about any forward price of any asset or derivative that at some future point that price, in your opinion, is incorrect and there is a play to be made. If you have a God-given knowledge that certain asset is not going to end up at the price that current forward market implies, you have potential to make money, regardless of what trajectory this asset takes on the way there, regardless of how many times it will go zigzag up and down on the way there. We can go more into this, but that's not the subject of this webinar. So what I'm going to do, I'm going to state my objective and what I'm betting on, and I promise to condense it to 5 words. And then I'm going to state my arguments, and I promise to condense them to 2 words. So what I like to do, as I am a mathematician by education, I like to start with axioms. Now in the market, there is no certainties. There are only certain likelihoods. But what I'm going to start with a few facts that I think most people will agree with. What it means is like we will never arrive to anything which will give us an absolute certainty. All I'm trying to do is to say that certain outcomes are more likely than others. So let's start with the first thing that we know. What drives Federal Reserve policy? They have the dual mandate, employment and inflation. For as long as employment is strong and inflation is higher than they want, they probably will incline to be hawkish. We know that. Now, what are we observing currently with employment and inflation? Listening to Powell's speech, he pointed out that core PCE, which what they most look at, has been too high, oscillating between 4.5% and 5%, but relatively stable this year. So high, but stable over the last 12 months. I am seeing the same thing on employment frontier. Very strong employment numbers, but relatively stable. That is where jobless claims are running not at their lowest levels, but at pretty hot level. Employment numbers running at pretty hot level, but not speeding up, accelerating. So we have some kind of inflationary employment stability, but on the hot side. That's what I believe we currently see. And I think it's hard to argue with that. The next axiom, which I think the Fed agrees with, Powell reiterated it in his recent speech, which I always think that, and I could support that one with some charts as a general idea, is the lag. What does it mean? Whatever we see on the frontier of employment and inflation is not a product of anything to do with current policy. This is a very difficult idea to internalize, but I invite everybody to think it through once again. Whatever inflation numbers or whatever employment numbers we see today have no relation to any policy moves in 2022. They're the product of policy moves, both fiscal and monetary, in 2020 and 2021. Employment probably has a little bit less lag, somewhere around 6 months to a year. Inflation probably has a lag 1 to 2 years. We could probably debate about the length of the lags, those lags, but I think most people would agree that those lags do exist. Now, if today's inflation was able to stabilize at the current levels, and today's employment was able to stabilize at the current level of heat based on 2020 and 2021 extremely expensive monetary and fiscal policies, what can we expect in 2023, 2024 based on the current policies? Now, current policies, current market and economic situation has a 5-strong attack on inflation. What are those? Policy rate, first of all, unprecedented speed of Fed tightening, not unprecedented, but a very rapid speed of Fed tightening, and more tightening ahead of us this year, most likely. We have a balance sheet reduction, and actually, we only had those in tandem once in 2018, and that led to easing cycle very soon after. We have falling asset prices, and we have negative fiscal impulse. Now, one could argue, well, there is still a budget deficit, but it is hard to argue that fiscal impulse is much lower than it was in 2020, and especially with relation to the GDP, which has grown quite a bit. And the last one is a stronger dollar. Once again, probably the strength of dollar is not as paramount to US as to some emerging markets, but the strength of domestic currency, but it's still a deflationary factor on the margin. So I believe that given the fact that the policy and economic conditions in 2020 and 2021 were sufficient to create strong but stable inflation at this point, and possibly even some continued upward inflationary pressure, it's very difficult to not imagine that they will create deflationary pressure 1 or 2 years from now, given our current conditions. Now, now the question can be reasoned, how do we know that what is done is enough, that we had enough tightening, that there is enough policy reversal? What if, because real interest rates are still negative, what if I'm still running hot? Personally, I look at leading indicators, and those include hard assets such as precious metals and cryptocurrencies. I'm looking at real estate, definitely slowing down. I'm looking at stock market, having a protracted grinding bear market, and I'm looking at commodity prices, which honestly stabilized against all odds. Food and energy, the fact that food and energy prices stabilized or even came off considerably off the highs could be given actual structural shortages is rather surprising and tells me that the monetary policies and the contraction of amount of dollars in the system is gaining traction. Now, suppose I'm wrong. Suppose this is not enough. This is, for those of you who follow my writing, this is where I unsheathe the magic sword of necessity. It is my opinion that even if I'm wrong, I'm right. Why is that so? Even if current policy stance is not enough, the Fed made it very clear to us. They're going to continue ratcheting up interest rates as long as they see strong employment and high inflation. What does it mean? It means that we could have a few more hikes in the nearest meetings. However, given what I said earlier, by the time we will see inflation trending down, they will be already at least 1 year late to reverse the course of action. In fact, personally, I think even if they reverse today, we're already heading to deflation. But I could be wrong about that. That's a speculative view. What I do know is that when the inflation starts tracking down, it will be already way too late, because that would mean, for example, if inflation starts tracking down early 2023, that means that the policy of early 2022 was already too tight. And as inflation tracks down, the current policy becomes tight for two reasons, even tighter for another reason, because of real rates continue to go up as inflation tracks down. Thus, I feel that there is almost no likelihood of any kind of soft landing or soft inflation drop. I think negative inflation is almost unavoidable because the Fed is so hellbound to bring it down to 2%, but there is no way they will be able to stop there because the momentum from policy lag will already be there. So hence, my objective is zero interest rates in 2 years. That's zero rates in 2 years. That's 5 words. And my argument is policy lag. That's 2 words. And on to Dominique.
That's great. Very, very compelling argument that you made there. And I liked your 5 words, 2 words. So let's hear the opposing view. So let's go over to Dominique. So Dominique, if you reveal yourself, Alex, you can hide your video now as well, so that everyone focuses on Dominique. And Dominique, if you just unmute yourself, I know you always have this issue. So Dominique, the floor is yours, 10 minutes.
Okay, cool. So first of all, thanks, Alex, for participating in this debate, and thanks to everybody for listening. And I hope you come back with questions. So my argument really has 3 prongs. Number one, inflation is high and persistent. And by high inflation, I mean inflation that is high enough to change behaviors. And to see that, you just have to plot nominal wage growth, a good quality index like the employment cost index or the Atlanta Fed, against the CPI. And you can see that you already have a feedback from the CPI to wages. And when that happens, inflation becomes very hard to bring down. You basically need to convince both workers and businesses to ask for smaller wage increases, smaller price increases. And unless you have cooperation between the two, the only way to do that is to slow down growth. And in our case, because inflation is already so high, above 8%, it's a recession. So in that sense, that's one point I agree with Alex. So first point, the Fed is really behind the curve and it's going to be really painful. Second point, the Fed has a flawed inflation model. The core planks of their inflation model are the inflation expectation augmented Phillips curve, and the natural rate. And I think this is leading them to underestimate the amount of tightening that they will have to do. Both concepts cannot be observed directly, and both concepts have huge logical and empirical issues. So I won't get into an academic debate, but let me just quote a few facts. The Fed keeps telling us that we're safe because inflation expectations are anchored. I'd argued inflation expectations look less and less anchored, whether you use University of Michigan consumer 5-10 years consumer expectations of inflation, whether you use the Fed own index of common inflation expectations, they're at historical highs or close to historical highs, I mean, relative to the period of low inflation that we've had. So inflation expectations look less and less anchored. And in any event, we've had a surge in inflation, even when inflation expectations were anchored. So in my view, the idea, which is what guided the Fed policy at the beginning of this surge in inflation, which was that as long as inflation expectations are anchored, inflation will self-correct. This has been falsified by the data. And then there is the concept of the natural rate of interest, which is again a concept that is core to policy, cannot be observed, has huge logical conceptual issues attached to it, a concept that was criticized by Keynes in the 1930s. There was a big debate between Cambridge, UK and Cambridge, Massachusetts in the 60s and 70s. And more recently, the BIS has very strongly criticized this concept. So the Fed is guided by the wrong signpost. Third argument, historically, if you look at previous episodes of high inflation, in order to bring inflation under control, the Fed has had to hike rates close to something called the Taylor rule interest rate. And the Taylor rule interest rate is basically an interest rate that is driven by the deviation of inflation and unemployment from their long-run values. I've used an estimate which was as simplistic as I could possibly come up with, and I get a value of 7 to 8%. And in all previous episodes of inflation, the Fed increase the Fed funds rate to close to that level. And so I don't see why it's going to be different this time around. Yeah, I'll try not to believe too much in my models, but I was really struck by the good fit of the actual Fed funds to the Taylor rule model. Let me just say a couple of words, since I have a little bit of time, about two things that are going on. One, the strong dollar. There's no question, every time is different. This time around, there are structural reasons why the US has to hike more than other countries. So we have a very strong dollar, which is negative for growth, negative for inflation. But for now, I'm still sticking to my 7 to 8% call for another reason, which is that, and I'm sure we'll debate this some more, we're seeing very little impact from the Fed tightening on the real economy. If you listen to the Fed, they claim they've been tightening policy since the end of last year because markets are forward-looking. They started to give up on their super dovish policies at the end of last year. So the curve moved, financial condition tightened. And also, if you look at the Fed balance sheet, we've had an enormous decrease in reserves. I mean, reserves peaked at the end of last year, somewhere around 4.5 trillion. Now we are at 3 trillion of reserves. And yet, look at the US economy. It's still in the pink of health. Look at the unemployment rate. So something is going on that means that the policy tightening is having much less of an impact on the real economies and in previous cycles. And I think this will force the Fed to hike more until it breaks something, very likely. And so that makes up for the dollar strength. And that's why I'm sticking to my 8% call.
Great. Yeah, you mentioned your 8% call, which you've had since the start of this year. That's been a very punchy call, but the market slowly has been moving towards it. So, Dominique, if you just switch your video off, what I'll do now is I'll just speak a bit about Macro Hive for 1 or 2 minutes to allow both Alex and Dominique to prepare their rebuttals to each other. So in a minute or so, Alex will give his critique of what he just heard from Dominique for about 4 or 5 minutes, and then Dominique will do the same of what she heard about Alex's arguments. So they hadn't heard their arguments before just now, so it's kind of their live reactions to each other's ones, and then we'll move on to a Q&A. So continue. I've seen 1 or 2 people have posted their questions already. Continue to post that. Then what I'll do is once they've done their rebuttals, I'll start to ask the questions from the audience. So just for some background on Macro Hive, Macro Hive, we set up Macro Hive about 3 years ago, back in 2009. And the idea was to provide high quality independent research for investors. Having worked at lots of investment banks, myself, JP Morgan, Deutsche, and Nomura, one thing I found is that there's less resources allocated to research on the sell side, and there's often certain constraints one has, and what we can talk about. Then the other side you find is that when you go into the social media world, there's all sorts of fake news and fake analysis. So Macro Hive tries to thread the needle where we produce high quality, objective research for investors. And we have products both for individual investors or so-called retail, private investors, as well as for institutions. So if you are an individual investor, so you invest your own money, you may have money for your 401k, you may have your own trading account or your ISA in the UK. We have a product for that. So I'm just showing you our site where this is the site Macro Hive Prime, which has research and analysis for individual investors. So recently we published a note on some new academic work which looks at how you can enhance your FX trading. If you look at bond flows, we look at whether there's a case for inflation being strong. And then if you just go through, we have other articles around which markets have seen the most extreme moves of late. And then also, you have notes from myself. So I published a piece a few weeks ago talking about being cautious on the equity bounce because of quarter-end rebalancing. We have explainers as well. So for example, we have a piece on what is creative destruction. Many people talk about that. That's a Schumpeter argument. How do rates markets price interest rates? So we use the SNB, the Swiss central bank, as an example of how you extract central bank expectations. What is an oil ETF? How they constructed. Then of course, we have our podcast show as well, which is free. It's on Spotify and Apple. So recently we've had people like Howard Davies. He's the chairman of NatWest Group, where we're talking about UK chancellors. Randy Schwimmer, he's one of the leading guys in private credit. We learned a lot about that. Dave Newman, he used to run macro trading in New York for More Capital, one of the largest hedge funds in the world. So these are all resources you can have. And if you do want to get access to this, just go to subscribe, and we have a free newsletter here. So you just subscribe there. Or alternatively, there's a paid subscription. So if you click here, you get the 60% off annual one, which we've done for this webinar. And then you'll get access to all of the research that I just showed. If you, as well as our Slack room, where you can talk to other members of Macro Hive, and you can exchange sort of views with each other. So you have 2 options. One is a free newsletter where you get some content, and then there's the full content over here. Then finally, we have an institutional product called Professional, which is much more deeper, which is for hedge funds, asset managers, banks, exchanges, and so on. So if you are a more serious investor, we have a high octane product where you can speak to me and the team, including Dominique, more easily over Bloomberg. We have the model portfolios, we have trading models, we have trade ideas across every single market you can imagine. So that's something worth looking at. Okay, so hopefully we've given enough time for both Alex and Dominique. So what we'll do now is let's go to Alex. So Alex, if you can switch on your video and your audio. And I'll give you 5 minutes now to give your rebuttal to what Dominique just said. Over to you.
Okay, thank you. Well, thank you, Dominique. I'm going to go as quickly as I can through most of the arguments that I can respond to. And first of all, I'll start with your first argument about wage growth. And I think this is the strongest ones in the sense that entrenched wage growth is by far, in my opinion, the strongest devil's advocate argument to my view. So if I'm going to be wrong, that's probably because of entrenched wage growth. Having said that, you have mentioned that entrenched, you cannot slow this down unless we have dramatic slowdown in economic growth. And that's what I think will happen. I think we're heading for really deep and protracted recession on the edge of depression, and probably globally. That's my central view. And that's the reason why, same thing that I'm answering about energy prices. There is a structural shortage of energy, and many people argue that current level of economic activity cannot be maintained with the current energy prices. And I am saying yes, but current level of economic activity globally just will not be maintained because dollars are getting sucked out of the system, and there will be not enough dollars to pay for labor. There will be not enough dollars to pay for energy. And if there will be enough, they will keep taking them out till there isn't enough. That's my argument. And so the question is only how quickly we will arrive to that point. Of course, you mentioned Fed being behind the curve, and that's, I think, where the core of our disagreement is. In my opinion, the Fed is catastrophically ahead of the curve. I could probably make an argument that I think that the appropriate interest rate is already zero. And because that's what we'll see, because that's a rate which is needed not now, but 2 years from now when it's going to matter. The rate today is going to matter 2 years from now. The appropriate rate today, therefore, is 0%. I'm not going to argue about Fed models being off and all this like neutral rate or whatever. I never was a big buyer of any of this stuff, and I never really fully even understood what it means, and I never had any idea how to make any use of it as a trader. So I'm just gonna ignore that part and defer to you as somebody who knows more. Now, regarding, you mentioned inflation expectations being entrenched. I was never a big believer of how inflation and expectation drive inflation, but this is what I see anecdotally, though I will admit only purely anecdotally. What was happening, say, a year ago, some business owners observing really highly negative real interest rates would say, well, we're going to borrow money at really low rates and build up our inventory because they had inflation expectations. Now, currently, the same business owners are unwinding that. They're going to wind down, draw down the inventory, and pay down the loans, which will further contract amount of money in the monetary system because they see inflation as somewhat stabilized depending what field they're in, but the funding costs have increased so much that it's worth for them to wind those trades down if they want, instead of rolling them over. Some of those trades are still running because certain loans are fixed, but any kind of loans that will have to be refixed or refunded in the next year or two, there will be a pressure to wind them down. And that's how the only way I see the most tangible way inflation expectations work. Now, regarding Taylor rule, I am
Okay, looks like Alex is frozen. I don't think it's just on my side. So while he unfreezes, so let me just message him. Yeah, let me just message him. This invariably will happen. Maybe this is Alex's point about prices. Prices are frozen. So he's maybe making a clever point. And so what we'll do is we'll just wait for him to come back on. It's funny, yesterday I was at a dinner for tech investors and new tech and Web3 and so on. But what I find quite remarkable in a world of, hey, Alex, welcome back. Let me just finish my little anecdote. I was just finishing my little anecdote, Alex. I was just saying, with this tech dinner, we were using a speakerphone that was kind of working and not working. And then we use Zoom, which kind of works and doesn't work. So for all this talk of Web3 and so on, we need to kind of get the basics right here as well. But Alex, we have you back, which is good. So why don't you continue?
Yeah, sorry about this. Believe it or not, it's like the first time I had a Zoom collapse in the whole 2 years of Zooming.
Okay, back to you.
Well, I don't know. So what I started to get to, I know where I got cut off. I think I got cut off around when I was talking about the Taylor rule. And,
yes, that's correct. Yeah.
And I just recently had a discussion about that. Literally like yesterday, I talked in detail about the Taylor rule and the really good fit there. And I agree that the fit is very good historically. The reason why I believe that the rate might not be exactly fit this way, the same way as it did in the past, is because we have on top, because in the past, we mostly calibrated just to policy rate, but this time we also have balance sheet reduction and too strong balance sheet reduction. Because not only we're reducing it nominally, but we're much more rapidly, ratio of balance sheet to GDP was being reduced over the last year because the GDP was growing nominally so much and balance sheet nominally stabilized and went into mild decline. So that factor, that reduction of balance sheet, on top of my other factors, makes me think that Taylor rule can taper off at a little lower rate than before. But that's all I can say about the subject. And the last point is economic strength. And there I will reiterate my point. All economic strength that we see right now has nothing to do, in my opinion, with anything the policy has done this year. That is, the policy changes, any tightening that has occurred so far has not and could not have affected economic strength. There might have been a tiny bit of a feedback from asset prices, because sometimes stock market fluctuations have a pretty fast, like maybe with 2 or 3 month lag effect on the economy. But because of solid balance sheets, because of consumers being in a good shape, because they are pumped up with cash from 2020, 2021, we do not see immediate effect of financial assets going down. It takes a while, it takes a couple of years for the policy to chew through consumer reserves. And that's why I'm targeting 2 years from now for 0 rates. They're being slowly chewed down and the effects of this cannot and should not be able to be seen right now. So once again, I go back to my 2 words, policy lag.
That's excellent. Yeah,
a
very, very good critique there. So let's go to Dominique. So Alex, if you switch your video off, let's go to Dominique. Dominique, unmute yourself as well. Yeah, so can you provide your rebuttal to Alex's arguments?
So actually, I don't think we are that far off on terminal points. I mean, we both agree that this ends up with a recession. I'm not so sure about, outright deflation, because we haven't had that. I'm not sure we haven't had that since World War II in terms of core inflation. Maybe we had it in the 1930s, but I think we probably agree on the terminal point. How we get there is where we disagree. I see the Fed funds trajectory probably higher than what Alex has in mind. And so let me make a couple of points about Alex's argument, which are very well taken. 2 small ones, and then a bigger and more important one. So the fiscal impulse, no question, we've had like the mother of fiscal consolidation this year, the equivalent of 8 percentage points of GDP in terms of deficit reduction. But if you look at this coming year, right now, we're probably going to have about the same deficit, budget deficit as last fiscal year. So in other words, I'd say the fiscal consolidation is behind us. Then the issue of what difference does QT make? And again, a very well taken point. Obviously, it makes a difference. But I would argue that during QE, the balance sheet expansion had much more of an impact on financial markets than on the real economy. Growth, remained quite, nothing to talk about, 2% a year or so. So why wouldn't the same thing be true of QT? I'm being deliberately provocative here, but the bottom line is the balance sheet is having much more of an impact on the financials and on the real economy. So you need to think of a feedback from this, collapse in markets that we are seeing to the real economy, to think that the Fed will need to do less this time around, which brings me to my big point. And again, Alex, I think is spot on with the issue of lags. So I've looked at the lags of policy in one of my notes, and specifically at the time lag between the start of the recession and the first Fed hike since 1960s. And what I found is that those lags fell between 6 and 15 quarters. And I would argue that this time around, we are more likely to be towards the middle or the end of the distributions than towards the sixth quarter, because paradoxically of strong balance sheet. I mean, we all know that monetary policy gets transmitted to the real economy through financial conditions. But financial conditions in turn impact the economy differently depending on the financial health of this economy. So, for example, before the GFC in the mid-2000s, banks and households had very weak balance sheets. So when the Fed tightened, the consequences were devastating. This time around, I think we're dealing with the opposite issue. Households have been deleveraging for the past 10 years. So they have low leverage. Also, 80% of their debt is mortgages. Mortgages are typically very long-term. And we are just coming out of 4 decades of falling interest rates. So basically, households have locked in low, very long-term rates. And the same applies to businesses as well. And then if you look at banks' balance sheet, banks are doing a booming business. I mean, their consumer loan and business loan are expanding, 10% year on year. It's accelerating every month. The only thing that's not increasing on banks' balance sheet is student loans, and we know why. So I would argue that this time around, it's going to be really hard for the tightening of the Fed policy to bite on the real economy. I would add that in addition to this strong balance sheet I mentioned, we also have some shift in demand that make it even more difficult for the Fed to tighten. So for instance, we're starting to have reshoring of manufacturing in the US. I've written about it. We're seeing it in the FDI, in the trade balance. We have ongoing expansion of manufacturing employment despite the very strong dollar. We also have a shift in the demand for durable goods that's much higher still now than before the pandemic, which suggests that it's a secular rather than a short-term shift. And this is one of the few interest rate sensitive components of demand. So it's another reason why the lags this time around are going to be much longer. And what I think is going to happen is that the Fed is going to continue pumping the brakes until it actually runs into something, until it creates a systemic financial event, but I think we are quite a few years away. So I think
excellent. Thank you, Dominique. There, we're getting a whole ton of questions, so people feel free to add more questions. We've got a whole bunch already. Alex, if you could reveal your video now, we'll just go to the Q&A, and I'll just fire questions at both of you from our audience. We have a whole bunch of questions around kind of policy rate, interest rate expectations, inflation expectations. So I'll ask you a few questions to that flavor. So one question from Adam was, how do you guys arrive at your estimates of the real policy rate? What's the input of forward-looking inflation in particular, and what level do you think the Fed's targeting? Who wants to go first? Maybe Alex, do you have a view on what you think is the right forward-looking measure of inflation to use to get a sense of the real policy rate?
Honestly, I think that's a better question to Dominique, because it's
more sure. Okay, let's get to Dominique.
That I expect. I think that if there is such a thing as a natural rate going forward, I think the natural interest rate is 0, and the natural real rate that is we're going to converge to over the long run is probably -2%.
Okay, it's punchy.
That's how the society will function. Like, that's kind of what society is moving towards over the next several decades.
Yeah, Dominique.
So there is no magic recipe for finding the real policy rate. For sure, first of all, we don't know how to measure expectation. It's not clear even that there is something, or if there is something called inflation expectation, it definitely cannot be measured up to the decimal point as the Fed models do. So definitely they are thinking about going to a real Fed funds rate. They've mentioned using their CIE or using the University of Michigan.
CIE is the Common Inflation Expectations published by the Fed. It's on one of the Fed sites. Yeah,
it's a fancy weighted average of all sorts of inflation expectations that are being published. And in terms of fitting the Fed funds rate, the fit to a Taylor rule is much better than the fit to a real interest rate rule. So the bottom line is no one knows, and the Fed is definitely very confused. Is basically has told us they will hike as long as they see inflation coming down unambiguously, and that is going to define ex post R star.
Yeah. Okay. Then we have another question just on inflation itself, where some people are saying that there's parallels to the 1960s, 70s, where you had sticky inflation. People kept talking it down, and inflation persisted into the 70s. Somebody sort of mentioned here, how about salaries and wages of lower income people sort of picking up, kind of the stickiness of inflation. So this, I guess, more for you, Alex. Like all of these kind of measures of stickiness and persistence.
Yeah, that is definitely, first of all, stickiness is always the argument, right?
Yeah.
But disinflation environment was also very sticky, and sufficient impulse turned it around. So my opinion that the impulse is right now sufficient to turn around the stickiness of inflation. So that's pretty much like the core of my response to that.
Yeah. Okay. And so there's another question, which is actually, this is a fair one. So it seems like, okay, really the disagreement between you two appears to be what's the rate which will cause material weakness in the services sector, which is less cyclical than goods. Yeah, so let's maybe sort of start with that. So I guess, Alex, Dominique talked about how the balance sheets of the private sector are healthier than before. People saved a lot during the pandemic and all of those sorts of things. So and bank balance sheets are healthier as well. So the the higher rates won't have as quick a effect on crushing the economy than what you're stating. Is that how do you address that?
Do you want me to answer this?
Yeah, Alex, why don't you? Yeah.
I will again go back to the policy lag. I will again point out, yes, balance sheets, yes, the loan business is going well, though actually credit impulse is beginning to roll over. Consumer credit impulse is beginning to roll over and flatten out, but it's still doing well. Yes, the balance sheets are very healthy. And it is the product not of current policy, but of the policy that was 2 years ago, which tells me that 2 years from now, they will not be healthier. And all of those things, again, they are all as they should be as a product of very expansionary policy. If you give out so much money as you did in 2020 and 2021, it takes a while to suck them out. Why do I think that the current levels are enough to suck them out? Is because I'm seeing leading indicators showing me that. If I'm wrong, it is possible that the rate that will require, that the terminal rate will be higher than say 4.5% that current market projects. It could end up being higher. While I see it unlikely to go to 8% given the time horizons that I'm having in mind, I'm not calling a particular stopping point, but the leading indicators and the time schedules that fit my lines show me that we definitely are, like, my bias is that we're doing more than enough now.
Yeah, and there's a related question, but on the other side, public debt levels are incredibly high. Surely, if the Fed was to raise rates to 7-8%, Dominique, wouldn't that just crush the whole system? Governments won't be able to pay for anything. I mean, just everything bursts at a time when public debt is so high. And surely would governments not want rates to be high either? So there's a bunch of questions around that issue.
So definitely, and thinking about what might break, because there I agree with Alex, things will break. And I think public balance sheets are definitely coming out of, I think, are the weakest coming out of the pandemic. So the issue of debt sustainability, I think is going to be front and center, and there is a good chance that the liquidity issues we see in global bond markets could turn into solvency issues in some countries. But in the US, first of all, look at the public debt. As you wrote, Bilal, it's actually falling relative to GDP. And I would argue that just like the private sector, the public sector has secured funding on a long-term, low-cost, long-term basis. I think the average duration of public debt in the US is something like 5 years. So it's going to take a while for an increase in the marginal cost of funding to turn into a substantial increase in the average cost of funding. And I would argue that the US is different because it has the global currency. It can afford to pursue expansionary policies and have a higher debt ratios than other countries around.
Alex, do you have anything to add?
I actually agree with that, and I would even say it's stronger. Of all the concerns that I have, and of all the arguments, public debt in the US is probably the absolutely least of my concerns. The absolute bottom.
Okay.
So I'm so little concerned about US public debt and sustainability, not even coming on my radar screen.
Okay.
Like, so many things to worry before that comes to fruition.
Okay, now there's a good question here in terms of trading your views. So a question, this is from Ashwin, a question to both of you. For your given views, how would you position yourself in markets? So Alex, given your worldview, what's your favorite trade to express that view? And same question then to Dominique, and then we can go. There's a follow-up question to that as well after that.
Well, right now I'm not gonna give specific strikes and stuff, but my approach is to various option structures which capitalize on rates going to zero, close to zero, somewhere on the horizon of 2 to 3 years from now.
And when you say rates going, is that like the 10-year rate or the 2-year rate?
No,
the front end policy rates. Okay, yeah. So you want to,
So basically, I wanna I want to start making money as the policy rate starts converging to zero.
Okay.
But I don't want to bet on one very specific point, so I want to spread it out a little bit.
Yeah. And then Dominique, what would your trade be? Presumably the opposite, I'm guessing, of that. So 2 years to go higher.
I have to defer to Alex. I'm definitely not of a trader, not of a market strategist. But how I would express my view, I think strong dollar. There are structural reasons why the US economy is going to be more resilient than other countries, and inflation will be tougher to bring down in the US, plus the risk of a crisis abroad, financial crisis abroad, are stronger than in the US. And I like the deep curve inversion view, not just because of my view on the Fed, but I mean, what's going on is that we are changing regime. And that's something we didn't discuss, but is actually also super important. We were in a regime of very low yields. For structural reasons, I think we are moving to a regime of higher yields, deglobalization. I also think that the politics and especially income distribution are going to become much more of an issue going forward, and that will resuscitate the Phillips curve, if you will. So, and the era of cheap energy is gone as well. So,
okay, no, that's fair. Yeah, so curve inversion, strong dollar, but on the front end, you would be looking for yields to be up in the next couple of years, more than what the market's pricing. Yeah, the other kind of follow-up question is kind of related to, so Alex, you know, when would you stop out of your view? You know, whether in terms of price levels or in terms of your scenario. I mean, what scenario would make you think, hang on, my thesis is wrong?
You know, people often ask me this question, and I never have a good answer for it. But usually what makes you change your view is some set of events and parameters that you cannot foresee. Because if you could foresee them, you would not have that view. I mean, I've changed my view on various things, like on dollar, on, for example, on inflation index bonds. I've flipped a few times over the last few years on certain views as new information comes in, but it was not ever something that I could predict. I don't have a benchmark. Like, for example, the more right now, the stronger economic numbers are now, the more Fed is incentivized to keep raising interest rates right now, the stronger my view becomes. Because the more I see, okay, the policy lag is leading us to be very hawkish now, the more dovish they will have to be. The more hawkish they are today, the more dovish they're going to be 2 years from now. So what would change my view? One thing that, and this is, again, a strong devil's advocate case, is what Dominique is mentioning, the idea about offshoring and political shifts. And I think political shifts could really shake things up if they're very radical. My opinion is there are definitely, like, for example, Dominique said the era of cheap energy is over, probably for the next 5-10 years. But then from 10 years now, my anticipation in energy will get 1,000 times cheaper as we introduce fusion. So same thing, we have inflationary processes, like semi-secular inflationary processes from deglobalization and onshoring, and really secular deflationary forces from population growth trends and technology trends. Right now, I feel this, like, and again, this is a little bit of speculative here. I feel cyclical forces right now will win. The cyclical forces of tightening of monetary supply and financial conditions right now will probably lead the way, while those secular and semi-secular forces will be battling each other out over the next 10 years. That's why I'm not a huge fan of actually being like long rates 10 years from now, because I think over the next few years, those semi-secular forces that Dominique talks about might bring, there is a possibility that even after we go rates to zero, those semi-secular forces will bring rates back up before they eventually settle at zero permanently. Okay,
noted. Yeah. And Dominique, what would make you change your mind?
Okay, so definitely the labor market. This is really the key to my view. Also, if fiscal, we get a good whiff of fiscal tightening. It's not my core hypothesis, but it's possible given the politics. What else? Rumsfeld, unknowns. So really hard. Yeah.
Okay,
So
no, that's excellent. We're coming to the end of the webinar. I mean, there's so many more questions, but hopefully we've answered most of the questions or the grouping of questions that people had. Feel free to reach out to me, then I could try to get answers to the questions, and then we can just publish it on our website. So just final thing is a big thank you, Alex and Dominique, for participating in this.
Thank you very much for having us. Hopefully it was good for the viewers. It was fun for me.
Great.
Thank you for the presentation.
And what we'll do is we'll have a recording of this as well available for viewing later on as well. So hopefully everyone can see that. So tell people they can watch it later as well. So with that, thanks a lot, everyone. And, have a good rest of the year.
Thank you.
Thank you.